Welcome back to Gold Rush Reporter. On this channel, we don't chase headlines. We study structure, momentum, and long-term capital flows, especially in gold and silver. If you're here looking for short-term trade ideas, this is not that channel. If you want to understand where money is actually moving and why, you're in the right place. Let me start with something most investors don't like to hear. Markets do not warn you politely before they change character. There is no alert, no headline, no countdown. Structural shifts happen quietly, long before price action makes sense to the public. And right now, we are living through one of the most important structural shifts in decades. Gold has broken out, not just in price, but relative to stocks. That distinction matters more than almost anything else. We are not talking about a simple rally. We are talking about gold outperforming the S&P 500, the Nasdaq 100, the Dow, and the broader equity market at the same time. That does not happen by accident. That does not happen for a month and then disappear. That signals a change in regime. To understand this, you need to stop thinking in terms of price charts and start thinking in terms of ratios. When we divide the price of an ounce of gold by the level of the S&P 500, we get a relative performance measure. This tells us whether gold is doing better or worse than stocks. And when you look at that ratio, something extraordinary appears. From roughly 2013 through early 2024, gold versus the S&P traded sideways. Up and down, yes, but within a very large horizontal range. That range lasted about 11 years. 11 years of basing. 11 years of energy building under the surface. Earlier this year, that base broke. If I removed the title from that chart and showed it to any technical analyst, they would say the same thing. This is a fresh breakout. You buy this. And they would be right. Except this isn't a stock. It's an asset class relationship changing. Gold is now decisively outperforming stocks. And here's the part most people miss. This breakout was confirmed. It wasn't a fake out. It wasn't a 2-week spike. November closed above the entire base. That is critical. Markets respect confirmation. Now ask yourself a simple question. Who is buying gold instead of stocks? It is not the average retail investor. Most Americans are still buying index funds. They're still chasing tech. They're still being told to buy the dip in equities. If retail were driving this, gold miners would be trending on every trading app. They aren't. This is institutional behavior. Large pools of capital are rotating, not emotionally, not politically, but structurally. Pension funds, sovereign funds, central banks, and professional desks are governed by one rule: own what outperforms. When gold begins outperforming every major stock index, mandates force capital to move. That's how regime shifts start. And this is not just about gold. Silver is now entering the conversation. And historically, when silver starts asserting leadership, things accelerate. But we are not there yet in this discussion. First, you must understand what gold versus stocks is telling us. This is not noise. This is not a hedge. This is not a short-term trade. This is the early stage of a multi-year shift in capital preference, from financial assets to monetary assets. Now that you understand what broke out, we need to focus on why this matters and why this type of breakout almost never resolves quickly or quietly. An 11-year base is not normal. That is a full market cycle. Actually, more than one. When an asset or a ratio spends over a decade moving sideways, it is not dead. It is absorbing pressure. It is transferring ownership from weak hands to strong hands. And when it finally breaks, the move that follows is usually proportional to the time spent building that base. This is where many investors make a critical mistake. They assume all breakouts are the same. They treat a multi-week consolidation the same as a multi-decade structure. That's wrong. Markets are fractal, but time matters. The longer the base, the more powerful the resolution. Gold breaking out against the S&P after 11 years is not a trade. It is a statement by the market. Let's rewind briefly. Back in 2011, gold was massively outperforming stocks. Then came the collapse from 2013 through 2015. Gold didn't just fall in price, it underperformed equities for years. That underperformance convinced most investors that gold was irrelevant. That sentiment is exactly what allowed the base to form. By 2015, gold versus the S&P had dropped toward the 40-50% range. It bounced. It fell again in 2018. It bounced again in 2020. Multiple tests, multiple failures to break higher. Each failure discouraged participants. That's how bases are built. What changed this year is not mood, it's structure. When gold finally broke above the upper boundary of that long-term range and held it, the market confirmed something important. Stocks are no longer the default destination for capital. And this wasn't limited to the S&P 500. When we compare gold to the Nasdaq 100, the strongest equity index of the last decade, the same thing happened. Gold broke out there too. That matters because the Nasdaq has been the engine of global equity performance. If gold can outperform that, then equity leadership itself is being challenged. The Dow? Already broken. The NYSE Composite? Broken months ago. Every major stock benchmark is now underperforming gold. That does not happen during a healthy equity bull market. Now let's talk about timing, because this is where people get impatient and do stupid things. A breakout like this does not mean stocks collapse tomorrow. That's Hollywood thinking. Major market tops are not events, they are processes. Look at 2000. Look at 2007. Look at 2021. Each time, markets went sideways, made marginal new highs, and exhausted buyers before rolling over. That's exactly what we're seeing now. The S&P has pushed higher on the surface, but internally it has gone nowhere for months. Lateral movement, distribution, fatigue. Meanwhile, gold is not just rising, it is rising relative to equities. That tells you capital is rotating quietly, not panicking. And that's the most important point. Smart money moves first and moves quietly. Institutions don't wait for headlines. They don't wait for confirmation from financial media. They act when momentum and structure tell them risk is shifting. Retail arrives later, usually after price makes the move obvious. This is why relative performance matters more than price alone. Gold does not need stocks to crash to outperform them. It just needs stocks to stop being the best option. And once that happens, even a boring equity market becomes a losing proposition compared to gold. Now ask yourself this honestly. If gold continues to outperform stocks for another year, how many mandates, portfolios, and models will be forced to adjust? That is the fuel. Not emotion, not fear. Reallocation. Now that we've established the structural breakout of gold versus the major stock indices, it's time to examine silver, which is about to enter the spotlight. And historically, silver moves even more explosively than gold once these shifts occur. Silver has been in a multi-decade consolidation, longer and wider than almost any other asset. From the mid-1970s through 2023, silver traded roughly between $4 on the low end and $50 on the high end. That's nearly 50 years of a price range, 2 generations of investors watching silver stagnate. For most of that time, it followed gold, but never matched gold's dimensionality in price moves. Gold had its eightfold surge into 1980, another eightfold surge into 2011, but silver never fully graduated. It repeated the same cycles without breaking out structurally. That's the key. Silver was waiting for a catalyst that aligned momentum, capital flows, and institutional recognition. November changed that. Silver finally broke out of the $50 ceiling. Not just in price, but relative to gold. That's critical. It signals a multi-month countdown for explosive movement. Historically, when silver breaks a long-standing relative base, the pattern is clear. Parabolic moves follow, not gradual appreciation. Price starts to accelerate in a compressed window, often catching retail by surprise. Momentum analysis confirms this. By tracking silver's logarithmic scaling from previous major cycles, the math indicates targets far beyond current prices, north of $500 per ounce in a theoretical logarithmic model. This isn't speculation, it's dimensional analysis of historical breakout behavior. Previous cycles in 1979 and 2011 both showed parabolic surges following structural breakouts, and silver is now in month one of its latest cycle. Another signal confirming the move: backwardation in the physical market. When the nearby price of silver exceeds futures, it tells us buyers want metal immediately. Delivery stress is rising in London, Shanghai, and New York. Physical demand is strong. COMEX inventories are declining. This is not retail panic, it is institutional and sovereign demand. Central banks, sovereign funds, and the largest proprietary desks are accumulating silver because they understand structural shifts in capital allocation. We also need to understand the geopolitical dimension. The freezing of Russia's $300+ billion reserves sent a clear message. Financial assets can be confiscated. Sovereigns and institutional investors are moving reserves into assets that cannot be frozen: gold and silver. This is why central bank gold buying hit all-time records, why India imported record silver tonnage, and why China is absorbing global refining capacity. This is a systemic shift, not a retail phenomenon. Meanwhile, the equity market is behaving as expected. Surface strength masks internal weakness. The S&P has been grinding sideways, making marginal highs, and slowly distributing shares from strong hands to weaker hands. This is a familiar pattern. 2000, 2007, 2021. None of those tops collapsed immediately. They labor, sideways, inviting dip buyers before the real decline begins. Gold's breakout tells us the market already knows what's coming. So, what does this mean for investors? Gold is outperforming structurally. It has broken out of an 11-year base relative to every major index. Silver is in the early phase of a multi-month breakout, following a pattern consistent with historical parabolic surges. Institutional money is leading, not retail. Sovereigns, central banks, and large funds are positioning ahead of public awareness. Market structure matters more than headlines. Price follows momentum and reallocation, not media narratives. To understand where silver is headed, we need to step back and examine historical patterns. Silver's current breakout isn't unique. It follows a recurring behavior seen during previous bull cycles. Let's go back to the 1970s. Silver spent decades in relative stagnation before erupting in the late 1970s. The low end of the price range was around $4, the high near $50. That breakout didn't happen overnight. Momentum had to align, institutional demand had to accumulate, and economic conditions had to set the stage. Once that happened, silver's move was parabolic. The rise was rapid, violent, and largely uncontested because the groundwork had been laid over decades. Fast forward to 2011. Silver repeated a similar pattern. After a long period of accumulation, it surged from roughly $8 to nearly $50 in months. This move followed a breakout of silver relative to gold, signaling the start of a major repricing. The key lesson is clear. Structural breakouts precede explosive price action. Price itself is a lagging indicator. Momentum and relative performance reveal the shift first. Today, silver is behaving in exactly this way. After decades of consolidation, It has finally broken out above the $50 ceiling and outperformed gold. This is significant because silver historically magnifies gold's moves. If gold begins a sustained outperformance against equities, silver rarely lags for long. Its history shows that once silver starts moving structurally, parabolic gains are likely. Another critical factor is physical demand versus futures supply. Markets are currently showing signs of backwardation. That means the immediate price of physical silver is higher than futures contracts. This is a strong signal that buyers want the metal now, not later. Delivery stress is increasing globally, in London, Shanghai, and New York, while inventories at major exchanges are falling. This isn't retail hype, it's institutional and sovereign buying. Consider the geopolitical context. The freezing of Russia's reserves sent a global shockwave. Large holders of fiat money realized that bank balances and paper assets can be confiscated. Assets that cannot be seized, gold and silver, suddenly became far more attractive. Central banks and sovereign wealth funds responded accordingly, buying record amounts. India imported record silver tonnage. China is absorbing global refining output. The buying pressure is concentrated, deliberate, and strategic. It's not retail panic, it's institutional prepositioning. Meanwhile, the equity market continues to show signs of internal weakness, despite surface strength. The S&P 500 has been largely sideways, making minor highs, while momentum analysis reveals distribution beneath the surface. This is exactly what happens during market tops. The market appears healthy, attracting short-term buyers, while structural forces slowly transfer shares from strong hands to weak hands. Gold's breakout signals that capital is rotating out of equities and into monetary metals, quietly and efficiently. This sets up a perfect storm for silver. Once an asset with historical leverage to gold breaks out, combined with institutional accumulation and supply stress, the conditions for a parabolic move are in place. The math from previous cycles suggests that logarithmic scaling could project silver targets significantly above current levels, far beyond what the casual observer might expect. For investors, this means one thing: timing is critical. Early positioning, before retail recognition, offers the most significant potential gains. Waiting until the media reports silver is soaring usually means entering late. History and momentum indicate that the next leg of silver's bull market could be rapid and steep. We've covered gold's structural breakout, silver's early-stage momentum, and the institutional forces quietly rotating capital away from equities. Now, let's put it all together and focus on what it means for positioning, risk, and the next phase of the metal cycle. First, gold. The breakout against the S&P, Nasdaq 100, and Dow isn't a short-term move. It's the confirmation of a multi-year regime shift. Markets don't break 11-year bases and then immediately reverse. History shows that these structural breakouts lead to years of sustained outperformance, not weeks. Institutional capital has recognized the shift. Retail will follow, often too late. That gives early adopters a critical advantage. Silver is where the real leverage exists. After decades of stagnation and repeated cycles of consolidation, silver has finally broken out above the $50 ceiling and outperformed gold. This is more than a price breakout. It is a structural breakout relative to gold, which historically signals explosive parabolic moves. Momentum confirms it, backwardation signals urgency, and physical shortages reinforce the trend. Institutional and sovereign buying is the engine behind this move. Central banks, sovereign wealth funds, and large proprietary desks are accumulating silver and gold because they understand structural risk in the financial system. The freezing of Russian reserves sent a stark message. Paper money can be seized. Real assets like precious metals cannot. That is driving demand far beyond what retail activity alone could produce. Meanwhile, equity markets are exhibiting classic topping behavior. They grind sideways, make marginal highs, and distribute shares from strong hands to weak hands. This is precisely what we saw in 2000, 2007, and 2021. Surface-level strength masks internal weakness, and gold and silver are quietly outperforming equities. This is not speculation. This is structural evidence. For investors, the strategy is clear: hold for the long term. This is not about timing a one-week spike or chasing headlines. This is about allocating to assets that are structurally favored over the next several years. Gold provides stability and long-term security. Silver offers leverage to the metal cycle, historically capable of parabolic appreciation once breakouts are underway. Risk management remains essential. No asset moves in a straight line, and short-term volatility is inevitable. But structural trends give you an edge. If your core allocation is positioned in physical metals or trusted bullion vehicles, temporary pullbacks are opportunities, not threats. History shows that during these cycles, those who focus on fundamentals and structure rather than short-term price action capture the largest gains. Finally, consider the macro context. Credit markets showing stress, the Federal Reserve quietly resuming easing, and sovereigns exiting dollar-denominated assets. All of these factors amplify the importance of gold and silver as monetary metals and portfolio anchors. Retail may still be distracted by AI ETFs, meme stocks, or headline news, but institutional flows are creating the foundation for multi-year upside. The takeaway is simple but profound. Gold has broken out structurally against all major equity indices. Silver has begun its breakout relative to gold and is poised for parabolic potential. Institutional capital and sovereign buyers are leading this shift, not retail. Equities may grind higher temporarily, but are structurally underperforming metals. Physical demand and backwardation signal urgency and scarcity in the market. We are at the beginning of a long cycle. The first moves are in place, the structure is confirmed, and the catalysts, both macroeconomic and geopolitical, are aligned. Those who understand the history, read the charts, and focus on the structural signals are the ones positioned to benefit most. Remember, the markets don't wait. Momentum precedes headlines, and structural breakouts precede price explosions. Gold and silver are in the early innings of what could be the most dramatic monetary metal cycle in decades. The next phase is not a question of if, it's a matter of when and how much. Stay disciplined, focus on the long-term structure, and let the market's internal logic guide your decisions. This is the time to observe, position, and hold, not react. Gold and silver are rewriting the rules. The smart money is already moving. The public will follow, and the opportunities in front of us may define the next decade for monetary metals.